let's look at each of these categories. So we've got the operating activities. Now, the other thing to realize here is if you're going to say, okay, well then the operating activities is basically like the income statement on a cash basis instead of an accrual basis. So you would think what you would do then is look at the income statement line by line, income, expenses, and convert them from a cash basis to an accrual basis, right? So I'll just recreate the income statement on a cash basis. That would mean that instead of recording income here, for example, when we earned it, which might be at the point that we entered the invoice, we don't record income until we actually received it, until cash was received. So, and you can kind of get an idea of that by switching to a cash basis up here. So if I switch to a cash basis, what's QuickBooks going to do? What it should do basically is create the income statement, but instead of entering the accrual components, recording revenue when a non-cash transaction happened, such as an invoice or a bill, and then only record transactions when cash is impacted, meaning income goes up when we have a cash register sale, which would be the same under an accrual or cash system, or instead of recording when an invoice is created, recorded when we have the received payment. Recording expenses when a check went out, for example, or an expense payment, but that would be the same under a cash or accrual, and not recording an expense when accounts payable happened, but rather recording it when we pay off the accounts payable, right? That would be here. So this switch from accrual to cash is basically giving you kind of an income statement on a direct, what we might call a direct method cash flow statement. So the bottom line down here, let's just check out, comes out to 698.73. Over here, it came out, so it's not exactly what it came out to here on the statement of cash flows, but that's the general idea. But the statement of cash flow usually uses what we call an indirect method. So what is an indirect method? Well, that means we're going to start with net income, which was 2088. Let me go back on over here and say, let's go back to accrual. Well, let me before I do that, let's bring this to 2024 and run it just to check it out. Was that 698? Okay, 698, and over here we're at, okay, that's not the same. Let's check it out. Let's make it go to accrual again and run it for 2024. So now we're at the 208838. So that's going to be our starting point, 208838. So you can see how on an accrual basis, the income statement will tie into the statement of cash flows because the net income will tie in. And then we're going to back out all of the things that are accrual. How do we do that? Well, we go to the balance sheet accounts that are accrual accounts, meaning accounts receivable is an accrual account. And we basically look at the difference or change in accounts receivable and back out the accrual component. Same with accounts payable, the credit card, and so on and so forth. Now, I'm not going to get into how do you do that in detail, but if you can do that, if you understand that well, then you really have a good understanding of the double entry accounting system. We have other courses and sections on that. If you want to do that, it's a really good exercise. I mean, if you could build a statement of cash flows, I have a good amount of experience with that because when I worked at CPA firms, we had to build the statement of cash flows, and like a lot of people didn't like doing it because they didn't really have a system to figure it out. So I got kind of dumped with that as a newer person, but then I got good at it, and I kind of enjoyed doing it to some degree. And if you understand it, then again, it's a really good practice to just understand the double entry accounting system. But that's the general idea is we're going to start with income and then back it out to cash flow on the income statement from a cash-based system. Now, why is the indirect method the one that's primarily used instead of the direct method where you would start with income minus expenses on a cash basis in essence? And the reason is because this gives you an added reconciliation. See, if I just started and made an income statement that was on a cash-based system, what would happen is that would be great, but I'm not really seeing the difference between the two. Whereas this gives me a reconciliation, kind of like a bank reconciliation, which says, hey, this is what the bank says is cash at the same point in time. This is what our books say is cash, and here's exactly what the difference is. That's what this is doing here, right? This is the net income that we say on an accrual basis. These are the differentiating factors that reconcile it to, in essence, net income or the total adjustments to cash on a cash-based system. All right.